Act negative to the curve itself, to the bond price itself. But when we look at the 5s, 10s, there's a lot more variance in the 5s, 10s, a lot more wiggle room to play the 5s, 10s in terms of macros. But we still got to remember there is a macro angle to curve trading. In fact, the macro angle to curve trading is probably more important than the micro angle to curve trading. And we can see that whilst the curve was very, very bearish here with the big rally in bond prices, which came from the bearishness of the curve, that macro angle gave us the best buy on bonds we could ever imagine. If we look backwards for a second, you'll see exactly what I'm talking about. We started to see what is called a bear flattener. Well, a bear flattener in my world is always going to be a big buy trade in most normal circumstances. So you can see that as it dropped down on a macro scale basis here, we simply start buying bonds by the barrel load to take advantage of what is going to be a big winning trade here with that bear flattener. You don't often get a bear flattener on the 5s, 10s. So that's the trade, that's the deal, especially when it drops even faster and even further. That bear flattener is huge. As soon as it hit the wholesale price 174s, the massive buy opportunity stepped into the markets and we made an incredible $4,000 positive swing away from that buy trade. When we see the market starting to steepen, well, we simply pay attention to it. When we start seeing that steepener coming in, we start drawing in some lines, some flat lines. Because obviously a steepener against flat lines becomes important. A steepener against wholesale price levels becomes important. Because if I can ever get into those areas of higher highs or wholesale prices and or higher highs, then we already know almost a perfect example of getting the deal done at that stage, because the bond should be doing the opposite to what the curve is doing. And what we got here was higher highs and higher highs for a sell trade. And I said that to guys this morning. I says, you've got to be aware of these stories. Because when you're getting higher highs on this macro, and if you were simply sitting on a 1-minute chart staring at this, you would never have seen this. You'd never have seen this. And that's what we start to recognize. You'd never have seen this storyline here. And obviously, when you start looking at that storyline there, you start thinking to yourself, no, this is all wrong. Selling into the high price has got to be the right trade to be on. And the sell at the high prices obviously was in the overnight session. You didn't really get much of a chance to join in. But obviously, we're now seeing that there is perhaps a peak and a trough in line with each other just in here. Whether it's going to give enough value or not, I'm not sure. You can see that the pop to the upside seems to be a little bit overcooked, but you know, there was a buyer in the book, and it's held the bid in the markets into the top edge again. So we may well get another opportunity to dance in here. But again, this is why we use the 2s, 10s in relationship to this, because the 2s, 10s tells us what the curve traders are doing with this narrative. Hold on a second. So one of the key aspects to bond trading is making sure you don't lose sight of the big picture. More than any other market, well, I say more than any other market, that's not true, that's actually not true at all, but the biggest trades in the world are curve trades, and the curve trade is not a scalp, it never will be a scalp. They're trying to get 10,000 contracts on the 10s, 20,000 contracts, 50,000. Over a period of maybe a day or a few weeks, they're trying to get 100,000 contracts into a particular curve trade. So it's not going to be something that's going to appear on a 1-minute chart as a 2-tick reversal. So when you start to recognize the curve, do not try and fight it, guys. Try and stick with the deal, because when you get these big curve trades, they are golden opportunities to make a lot of money. You've just got to make sure you always default back to the macro swing picture of at least the last couple of days to see what the hell is happening. Is it always a negative correlation? Well, that's a great question. There's one way of being able to find out, right? Simply go into maybe a 30-minute chart and see what it looks like. When you go into a 30-minute chart, you can see the overall big shape of the markets. You can see what we should be doing at certain prices in terms of macro shapes. There's the high and there's the low. So what should have been happening to bond prices? Well, if that's the high price and that's the low price, the bond price should be it should be here, shouldn't it? So look at all the opportunities on a macro scale. Do you see them? Do you see them? All the opportunities on a macro scale should be buying into key swing lows. There's a key swing low here, so there's a massive opportunity to buy bonds in there. And then there was a massive pullback here as another massive opportunity to buy bonds in here. And when you see that storyline evolving there, you start saying to yourself, right, with this rip back to the other side here, I should be able to start looking at that rip there and saying, right, well, that should be where the bond price is going to. And you can see exactly where the sell trades were coming in, right here. And you can see the sell trades were coming in right here. So that's the idea of simply trading against duration. I've got a premium or a discount to duration on a macro scale, but this is another good reason why looking at the 30-minute charts is a useful idea, because you can see how much movement this price has in amongst that 30. It's quite wide, isn't it? It's quite a wide variable. So we've got to be allowing it to be a wide variable. We can't simply, as soon as it turns, deal. But the idea is we've got to at least understand the relationship. Now, what causes this to move? Well, we've already covered the idea of the 5s, 10s anyway, but we also can look at, obviously, the idea of the 2s, 10s to see how the 2s, 10s behave inside of those worlds. It should be a positive correlation, of course. And when we look at the 2s, 10s against the 5s, 10s to find out whether it is a positive correlation, of course it's not, because it's almost a perfect positive correlation to what? The 2s, 10s, because it's got more curve in it, is almost a perfect correlation to the bond price. So this is another way we can verify what we're going to be doing, because obviously we've already established, well, how do the banks trade this? Well, obviously, if they're going to be selling the blue line and buying the black line, what are they actually going to be doing with interest rates? Isn't this the interesting thing when we come to bond trading? Bond trading isn't about what the black line and the blue line are doing per se individually. It's about what the black line is doing in relation to the blue line and vice versa, right? So if the blue line is the 2s, 10s, let's just make sure we're clear about what we're seeing. If the blue line is the 2s, 10s, we simply can draw that into our story here. So 2s, 10s. Is the ZTZN, correct? So anytime we see the 2s, 10s, we're looking at the blue line here, which is the ZTZN. What's the black line? ZFZN, right? So the black line is ZFZN. And now we know what the trade is. It's crazy, isn't it? So for example, if I sell the blue line and I buy the black line, what am I actually selling? I'm selling ZT, but obviously because that's ZT minus ZN, I'm going to actually buy 10s. Okay, so I'm buying ZN. So if I'm selling the blue line, I'm selling ZT, buying ZN. And if I'm buying the black line, I'm buying ZF, but what am I selling? Well, ZN. So what does that take out of the equation? It takes out the ZN. They are both balancing each other out. So in other words, what are we left with? A move in interest rates. What we're left with is a ZTZF, which is 2s, 5s. It's an interest rate move. So when we see a big difference in these two markets, we already understand that interest rates are falling or rising when this happens. So when we kind of get a grip around this, when we start thinking about that as a storyline, it starts to make sense, doesn't it? It starts to make sense. The whole shape of interest rate movements starts to become pretty obvious, because inside this narrative, of course, the ZF rising and the ZT falling, well, the ZT falling, of course, means that short-term rates are rising, right? So short-term rates must be rising. So inside of this scenario of selling the blue line and buying the black line, what direction are short-term rates going in? Up. Short-term rates are rising. So this is a rise in stirs. So if it's a rise in stirs, what are going to happen to bond prices? when prices generally as a rule start to fall. We start to recognize these obvious elements, right? We start to recognize the story behind what's going on in the background of every single one of these charts. Now, there's obviously a short-term context to this, and there's a macro context that we always accept and we always acknowledge. We always try, basically, and trade the markets towards the belly. Why? Because the belly is the pivot price. The front end's too low, that means the back end is too high. The belly is the pivot that shows us that swinging influence. If the front end is too high, the back end will be too low. That pivot price in amongst the 5s, 10s is critically important to us. But we get the basic idea. The belly is probably the most important part of the curve because all the rest of the curve is usually pretty much aligned almost perfectly with the bond price itself. So when we understand that, the belly becomes critical. But obviously, if we lose sight of the back end, we can miss out on some great trades. For example, just on the basis that the 2s, 10s is almost a perfect negative correlation, we'll take the 5s off for a second. And if we look at the 2s, 10s, and it's almost a perfect negative correlation, you're already able to see two amazing trades. First of all, the lowest low we had on the 5s, 10s was here, and yet we had a higher, they had a higher high here. There's a great opportunity to sell very, very, very high probability bonds because that's got so much curve in it. The chances are getting less and less and less. So a divergence on the 2s, 10s is a lot rarer, but even more powerful than the 5s, 10s. Where else did we have a divergence on the 2s, 10s? Well, interestingly enough, when the bond price made another higher high here, the 2s, 10s was nowhere near where it was before. So there was another huge divergence on bonds just in there. And again, it's definitely a lot rarer for bonds to be diverging against the 2s, 10s, but when it does happen, it's a crazy, crazy, crazy good trade to take advantage of because you're dealing with a big chunk of curve there that should be reflective of bond prices. It's as simple as that. And this is the meat of the curve. This is the 2s, the 5s, and the 10s. The big volume trades of the 5s and the 10s included in this part of the narrative. So when we see that, and you think to yourself, well, they were the best trades on the planet, and look at the amount of money you made on those. $4,000 on that sell trade there, and potentially somewhere in excess of $3,000 on the first trade. That's pretty good business. Take it back down to a 5-minute chart basis, and you start asking the same questions. Well, you saw exactly the same answer here. That's the same trade. You saw the same answer here, but you also saw the same answer here, didn't you? Look at that trade there for a bond sell. Look at the 2s, 10s, guys, in relation to that bond sell. The 2s, 10s was already rising steeply. The bond can't be a bid. It can't be a bid. It's impossible for that bond to be a bid there, surely to goodness, unless something weird is happening in terms of risk hedging. But that's something you can check on. When you make a higher high on bonds, you check your 2s, 10s. It's nowhere near the previous lows. And you think to yourself, no, this is definitely a sell on bonds again. Definitely a sell on bonds again. And you keep going through the process. When I got a higher high on bonds here, the 2s, 10s was higher lows. That can't be right, surely to goodness. The bond must be a sell. It's dead obvious, isn't it? The only downside is this one doesn't print quite so much. So when you take it down into the 1-minute chart, do you see any opportunities in a 1-minute chart? Well, that's a tough call, but yes, sometimes you do. So for example, you saw when this bond made a lower low there, the 2s, 10s was not making a higher high, and you said to yourself, I'm going to buy some of this. Well, we did buy some of that. But it also put us into the mood to buy on when it broke again, but the 2s, 10s did break with it this time, and we had to just be patient with the 2s, 10s during that break higher. But obviously when it starts coming back out in place here, we start watching, and you can see what happened into the high price here. You will all be able to recognize that when the bond went higher here, this 2s, 10s had not went lower, which means there's a very high probability that there's going to be a big bid on the 2s, 10s when it touches into that area, and that gives me the timing signal to start smashing into some short bonds up here. Gives me a great opportunity to start smashing treasuries there. So we can trade this almost exclusively using simply just curves. Now, we obviously build into this story by using the 2s, 10s and the 5s, 10s. The bigger the divergence, if we get divergence in both, it's called a parallel shift. I mean, if we could get 1 billion contracts in those trades, we'd take 1 billion contracts. You know what I mean? But the point is, you've got to make sure you see it. One of the things I'm already recognizing about this bond is that this retested low here has not got the support of the curve at the moment. If you look at where the curve was before, now the bond's obviously a little bit shy of that previous level, but on a relative value basis, you've still got to be aware. Now the 2s, 10s has came in. Okay, so that's okay. So we can let it go through now. Hopefully that'll go through, but you can see that the curve keeps on coming back off again. So there's a very, very good chance that this trade to the downside might not carry on that far. And therefore, as a result, you just say, you know what, I'm going to take a little bit of money here, just in case this is a developing story that I'm going to be paying attention to as we come into levels. The levels are on the 2s, 10s, the 5s, 10s, and the bond price. Every time you break a level on any of them, you make an assessment. So when I break a level on bonds, I make an assessment on bonds. When I break a level on the 2s, 10s, I make an assessment on bonds. When I break a level on the 5s, 10s, I make an assessment on bonds. I'm always making the assessment based on what levels are breaking and how we're going to get into those bits of business. So it should make perfect sense when you understand these elements. There is lots of money to be made from understanding this very, very simple process, guys. It's just about making sure you get into the stories, and then obviously if you want to expand that story into the knob spread as well, you can do so. But the main thing, of course, is you start recognizing that these two lines should be running parallel. These two lines, the blue line and the black line, they're inclusive of each other. They should be running parallel. And the wider the spread becomes, the bigger the chance is that there's going to be a curve trade. So when I see that trade setting up there, and I can see I've already got a premium up here, this is going to be a buy trade when it touches that low. If that's going to be a buy trade, I've got even more value to be a sell trade up here when it touches into that high. If I don't take advantage of that, guys, I am not a bond trader. I am not a bond trader, because that's the most obvious bond trade on the planet. It's the most obvious bond trade on the planet. It's the one you must have always, because it's a straightforward curve trade narrative. It's called a premium or a discount to duration. This is a premium to duration, and obviously if you've got a bottom edge price, you've got a discount to duration. You want to be on those trades. And obviously you can start looking into the adjustments of the DVO1s when you get into this area to try and fine tune your entry process, and that's what you start hunting for. You start trying to fine tune your entry process on your bond in those areas, and you start looking for that trade narrative. Now that was a tough one on the DVO1s because we never really got anything up here. Does it matter? Well, yes, it matters. It just means I've got to be patient, right? I've got to be patient. I've got to make sure I get the right order flow because I have no DVO1 adjustment to help me. We've got the blue line staying low, so there's at least something in it. If the blue line was up here, I would not be taking the sell. But the blue line isn't up there. The blue line, which is obviously the 5x4s, is nowhere near the high price. And that just gives me enough confidence that there is a sell up here in this area. And it's just a case of working prices. And I'm going to take pretty much every price up here. I'm not trying to find the best price. I'm trying to find every price that I can get a bit of volume on. So there's sell trades in these areas here against any buyer that comes in. And that's all you've got to remember, is that it's not one price, it's many. But as you as a trader, you try and find the block. You lean against the block. You see a seller coming in behind you, and you hammer the sell trade. And if you have to wait for the price to start dropping, wait for the price to start dropping. And then make sure you're on board those big, big opportunities. We'd already told you that the bond was going to be a sell, and it did sell off the high. It dropped a little bit and it scratched out, but you can see the next sell trade into the next high was easy, and the drop off has already taken place. You can see how easy money that was. The buy on the pound that we talked about, in line with the fact that there's no sellers anywhere, you're obviously seeing that there was another opportunity to buy in here, an easy money buy side response. The market that's setting up for another possible sell is this free run into oil here. There's no buyers up here, so that's something that we're aware of. So we can put ourselves into an offer watch up here on oil and see if anything shows up.